Well, hi there. So in this video, we're going to introduce Unit 8, which is all about the financial sector and monetary policy. Before we get into the weeds of what banks do and what central banks do, first we need to talk about what money is. So let's get started. Okay, so you can see I already got started a little bit here and just writing that before we actually define money, first we need to talk about something called financial assets. And financial assets are something of value. The financial part, we're going to kind of drill down into a focus a little bit. Financial here means that it's something of value that derives its value from a contractual claim, from a contract, from basically a claim on something else. And money is considered a financial asset. Typically, financial assets are what we call intangible. You can't touch them. And most money actually you can't touch. It's just electronic ledger money. But there is some money that we can touch, and we're going to refer to that money as currency. So the first type of financial asset that most folks are familiar with is currency. That's physical money that's circulating as cash. And we define that as fully liquid. That means that it's actually equal to cash, close to cash. Close to cash. And cash is obviously exactly the same as cash. So liquid just means that it's really close to it. And something that's more liquid is closer to being cash, and it's easier to turn it into cash, is a way to think about it, right? The other type of money that we would consider to be a financial asset is a deposit. And these are money that's been deposited into a financial institution like a bank or a credit union. And both of these we would consider to be forms of money. And we'll get back into that, what is money, in just a few moments. This is very liquid, we would say, that most deposits are really easy to turn into cash because you can just go to your ATM and get money out. And the rate of return is very low or none for currency. And we would say that it's also just very low for deposits. Typically, you don't get much money rate of return, meaning like how much money your money earns for you. If I have a financial asset, sometimes financial assets will actually grow in value faster than the rate of inflation, but obviously currency does not. If I have it in my wallet, it's never actually going to grow in value, and it actually is always negative because of inflation. Most of the time, bank accounts also don't keep up with inflation, so that's why we'd say it's a very low rate of return. There's a moderate level of risk in holding currency. Obviously, in addition to discretion and theft, there's also the risk of inflation, and that inflation would erode the value of it. That's more true for all assets, right? So we can kind of just say for all assets. That inflation is a risk for all of them. But we'd say it's moderate because if your money, the currency that you have is destroyed, you literally don't have any backup. There's pretty low risk for bank deposits. That's because governments insure most bank deposits, and you can essentially be guaranteed to some level that if your bank fails, if your bank goes out of business, that you can get some of that money or all of that money back from a government insurance program. Now, there are other types of financial assets out there. There are loans, for example, and one specific type of loan that you need to know is called a bond. A bond is a type of loan in which, as you pay it back, you just pay interest every single month until the end of the term of the loan, in which case you pay the full loan back. Some loans are not structured that way. They're structured where every month you pay a little bit of what you owe back along with interest. But most bonds are structured that you don't pay the full amount back, what we call the principal of the loan. You don't pay the full amount back until the end of the loan. But bonds and loans are considered financial assets because there's something of value. If I have an IOU that says you owe me money, that's a piece of paper that I could then sell to someone else, and it's a contractual claim. It's a claim that you owe this person who owns this piece of paper money at a certain fixed interest rate. We will find that bonds and bond prices are inversely related to interest rate changes. So I'm just going to have you put a star next to that and note this. I'm going to come back and explain why that's true later. But in general, we would say that as interest rates in the economy rise, bond prices will typically fall, and vice versa. We would say that bonds are only moderate to low liquidity because you're going to have to take time to sell the bond to someone else. You would have to say, look, I have this IOU from General Motors, or I have this IOU from the United States government, and it says that I'm entitled to money. Do you want to buy this piece of paper from me? So you'd have to find someone who would actually buy it and transact it and then turn your money back into cash. So that's why we'd say there's less liquidity with it. We would say that there's a moderate rate of return with things like bonds. These are kind of typical rates of return for kind of generalized and speaking about the bond market, but you could get very different bond rates depending on who you're lending the money to. If you're lending money to somebody who's not very trustworthy, they have high risk of not paying you back, then you might charge them a higher interest rate that's called the risk premium. Then we have this level of risk. And again, we can say this is moderate. It really depends on the borrower's risk of default. The last type of financial asset that we're going to look at are called stocks. Stocks are a share of ownership, entitling you to a share of profit, and often the possibility that the value of the share could go up. We call that a capital gain. This is the increased value of your share. And so for stocks, we would call them also a financial asset, but they are not money, just like bonds are not money. Generally, we'd say that they are moderate to low liquidity. Again, you would have to find someone who would buy that share of stock, and then you would turn that money into cash so that you would actually have cash. Generally, we'd say that stocks have high rates of return or moderate rates of return. Kind of varies, again, depending on the particular company, depends on the company profits and growth trajectory, but they have higher and moderate rates of risk as well. So you can kind of note that there's often a trade-off here between, well, rate of return, you're going to have some level of kind of trade here versus liquid rate of return and risk. And often that's kind of a balance that folks have to try to do. Now, diving down into a little bit about money, because these are the two that we're really going to focus on is currency and deposits. But I did want to share with you what these other financial assets are. Money is what money does. And any actual financial asset that is functioning as money is money. Money is an abstract creation. It's not something that like you can touch it necessarily. It is completely invented by us as humans, and we use this kind of thing that we call money to do three specific functions. If you have something that you're calling money, it needs to do all three of these things really well. So those three things are medium of exchange, unit of account, and store of value. And so these would be most commonly in the United States, bank deposits and currency, which are what we just listed. But a medium of exchange is this kind of function of money where when you go to buy something, you can actually pay for that thing in money. The contrast of that would be a barter system. And that double coincidence of wants is going to maybe be a problem that you would have with a barter system. So the problem with the barter system, right, that's the problem, is that it relies on this thing called a double coincidence of wants. So in short, imagine that you didn't have money. In order to actually get anything of value, you would have to exchange it for something that you have. So you would go to the grocery store and be like, I have eggs. I need a quart of milk. Can I trade you 6 eggs for a quart of milk? And that would rely on you wanting what they have and them wanting what you have. And that's pretty rare. So the double coincidence of wants makes bartering really inefficient. It's difficult for us to actually use that in a modern economy. So we use this thing that's in between, that's in the middle, hence the name medium of exchange. It's in between those two, and it bypasses the problem, the double coincidence of wants. Now, everything that's money has to be a good medium of exchange, but it also has to do two other things. It has to be a unit of account and a store of value. And a unit of account is literally just the unit of value. So it's a way that we can kind of think about what's the value of something. And we say, well, that's worth about $20. We're using money as a unit. That's the most important kind of piece of this definition. We're just measuring things' value using money as a unit. So if you have something like, say, Bitcoin has a really, really high value for one Bitcoin. So it doesn't really work very well as units. Pricing a pizza in Bitcoins really relies on having tons of decimal places. And so we wouldn't really say that Bitcoin does a very good job of unit of account. Bitcoin also is not widely accepted as a medium of exchange. So it's not a really good medium of exchange either. You could use it that way, and maybe in the future it would be, but not right now. Nor is it a really good unit. Again, price gas in Bitcoins. It would be like 0.0000002 Bitcoins, right? And that's something that's really hard for a lot of people. Third thing that money has to do for it to be considered money is it needs to store value. So store of value. This means it doesn't spoil, it doesn't die, it doesn't rot. So there are certain things that are better than others. Another way to think about store of value is that not much volatility, not much change in its value. And that means that if I put money into my bank account, if I put money in my wallet, then I return back to it later, it's going to buy basically the same amount of stuff. So money that's functioning well will keep its value pretty well. It will be an easily divisible number that people could use to price lots of things, and it would be widely accepted as something that I could pay for things with. If it does all three of those, then we consider it to be good money. And again, anything can actually be money. In some prison systems, sardines and cigarettes are money. On the island of Yap, there are giant stone wheels that work as money. In the United States, we use these fake little pieces of cloth paper that we call dollars. Those dollars are what we call money, right? It doesn't really matter what we use as the stand-in here. We could use stone wheels, we could use pieces of cloth or paper, we could use beaver pelts. There's pretty much anything that we can use as money as long as it does all three of those things. Now, a couple other things about money to know. Money and interest rates. Generally speaking, we'd say that interest is what the opportunity cost is of holding on to money. And so actually, when we talk about kind of money, we would say that the price of money, if I were to borrow it or lend it to someone, we refer to it as interest rates. We'll come back and talk about bond prices and interest rates in the practice set a little bit later, because that will help you understand that the interest rate is really just the opportunity cost of holding on to money. You're giving up the ability to earn that interest. Now, types of money. There are two types. There's what we call commodity and fiat money. Commodity money is money that has an intrinsic other use that gives it value. That can often mean that the value of commodity money goes up and down as the supply and demand for it for other uses changes. Most countries around the world today use fiat money. Developed economies around the world for decades have used fiat money because it avoids the problem of the ups and downs of value of, say, using gold or silver or anything else. Instead, they just say, this is our money. Fiat means make it so by decree. The government just says this is the money that we're going to use. And it simplifies things quite a bit, and it allows you to actually control inflation in a much better way than using commodity money. So again, really, this is just saying, do you have kind of other uses, gold, silver money, or is it just money that has no backing, right? It's just money for money's sake. The last part to know about money is that we count how much money there is. And there's four different kind of what we call monetary aggregates. These are added all together counts of how much money there is. The monetary aggregates are actually in kind of nested concentric circles. So the first one that I want to talk about is this one, this big concentric circle that we're going to refer to as MB, right? So MB includes bank reserves, which would be money in your bank teller drawer. It would be money that the bank has in its own bank accounts, right? So bank money and currency in circulation. So it's these two together. So it's kind of like this big circle. That's the money supply that's actually directly controlled by the government. And we'll come back later and talk about why and how the government can change how much bank reserves have. But obviously, the government can control how much currency in circulation there is. They can create more, and they can actually destroy money as well. But if we add these two together, we call that monetary base. That's the base money supply that's directly controlled by the government. Now, there's also within it that monetary aggregate of M0. M0 is just the currency in circulation. It's the money that's as close to cash as you can get, and that is cash. Now, going this way, currency in circulation is also considered part of what we call M1. So M1 is actually a couple of things. It's the currency in circulation plus all the checking account money and savings account money in the United States. And so these would be all the dollars that are counted as part of your checking and your savings accounts, plus how much money is circulating out in the broader economy. That would be money that's in your piggy bank. It would be money that's in the gas station in their drawer. It would be the money that's at Target or Costco when they pull out their drawer and say, oh, there's how much money we have. So all of that is currency in circulation. If we add checking and savings, we get what's called M1. Then we zoom out even farther and we say, well, what if we added to that all the money that's in a special type of savings account called a CD, a time deposit? CD here stands for certificate of deposit. And it's really not that they give you any special certificate. They used to do that, but they don't do that anymore. Instead, it's literally just a special kind of savings account where you can't get your money out very easily. And so thinking about this as a savings account where your money's kind of stuck there for a certain amount of time. If you take it out early, you lose all the interest. Then there's the money that's not quite cash. It's your checking account, your savings account money. And then there's the actual cash, right? So it's kind of these little M0, M1, M2, and these are all nested kind of accounts and counting up how much money there is. So it's just different ways that we actually count how much money there is in the whole system. We'll do some practice problems with it that show you what those might look like. Hopefully this helped you with understanding the basics of financial assets and also some concepts related to money. I'll see you next time.